We're still in conversation with Saker Nusseibeh, the head of investments at Hermes Fund Managers. Saker, let's talk about the money that pension funds manage and the opportunity. You've spoken about a whole lot of asset classes between EM equities, DM equities, debt in both the regions, and currencies and commodities. Where is the opportunity for 2012?
I think probably the opportunity that is most overlooked is large cap equity in developed markets, particularly in the United States. I think that's an opportunity that to me is clear as one that one should be taking from here. If you're looking at style, and I'll come to emerging markets in a minute, if you're looking in terms of style, in this move towards de-risking, value has done remarkably well as a style. If you're entering a period where companies are growing their earnings, then some move back to growth style. I don't mean a high PE, I mean the growth in cash earnings growth. Why? Because you can pay dividends. So in some ways I'm saying we're going to go back in emerging markets, in developed markets, or should go back into thinking of equity as a dividend paying play and calculate companies or the attraction of companies simply on a dividend model, paying model. That's on one level. In emerging markets, and I'll come to that later, in emerging markets, I think, as I say, it depends. There was a perception that the star in emerging markets was China, almost more so than anywhere else within the BRIC universe, and I'm not entirely convinced I buy the BRIC universe anyway, other than it sounded good for a product produced by an investment bank. The issue with China is they clearly have a credit problem which has been sat on. It's in the provinces, but it's still there. The central government is willing to underwrite it, but we have to see it come through the system. And they do have issues of social tension and political tension as they make their transition. And therefore, I am more cautious about how China progresses. By contrast, I'd say that India has, in the longer term, higher attractions. It has a very stable system. I mean, I know you're going through elections, but it's still a stable system. Because there is an economic system, there is a political system, which is a democratic political system. If there are issues of corruption, it can be dealt with through the democratic system. It's a system which is beginning to open up. And if you look at all the attractions, supposedly within emerging markets, India has more of it. It has a growing population, it has increased urbanization, and it has a very high skill base. So it does have some of the very strong aspects of it.
But between EM equities, which is a story that's been played out quite significantly, versus EM debt and corporate debt that you spoke about, where you see an opportunity, which one looks more lucrative, more attractive to you?
I mean, EM debt is interesting. You can't buy sovereign debt at all of EM, otherwise it would be really interesting. I mean, if one could really buy Chinese sovereign debt, for example, that would be a very interesting way of playing the market. That's out. That leaves emerging market corporate debt. That is theoretically attractive, but it's not well researched. But it is a theoretically attractive prospect. And so for the time being, the easier route would be to go through emerging market equities, but I see at some stage a growth in emerging market corporate debt.
A lot of money has been directed to markets across through the ETF route, and you've spoken about this in one of your comments, that you believe that there's a bubble building up in that product, just like what we saw with the CDSs earlier on. What is your observation there with synthetic ETFs? Because even for a market like India, a lot of money comes in via the index-based ETFs, via commodity-based ETFs, or even sectoral ETFs.
Yeah.
So what is the concern there, and do you think that this is a product which one needs to be wary of?
An ETF for every share of the index in the Indian market is counterbalanced by the issuing bank actually buying the share and holding that as security for the ETF. I have no issue. Where I start having an issue is when the issuing bank starts selling more ETF exposure to the Indian market than shares they hold, because that's leverage. I mean, it's as simple as that. I have specific issue where they hold synthetic ETFs, meaning where the underlying surety for the ETF is nothing to do with the index that they're selling. I mean, typically they go around this by saying, well, we mark to market at the end of every day, and we make the difference, which is fantastic as long as the bank survives, but even large banks apparently don't survive. So there's an element where I'm not quite comfortable with the instrument, because it has potential for creating leverage and for creating bubbles and for crashing. As we enter this de-risking environment, not because of a worry about markets, but because the regulator is saying to various pension schemes and insurance companies to reduce their risk. There is a temptation, as you reduce your equity exposure, to try to get some kind of levered equity exposure. We see that in the regrowth of the hedge fund route as a way of exposing the long-short equity route to try to increase the exposure to equity. We might see ETFs being used as part of that exposure, and my worry is that, again, you're building leverage into the system. So we come back to your question. If an issuing bank holds exactly as many shares on its book as it does in the ETF that it issues, fine, that's just an index. If it starts issuing more shares in the ETF than it holds as a surety, I have a real problem, because that's leverage. If it holds synthetics, meaning it holds a value in something else and issues you shares in the Bombay Stock Exchange, I really have a problem, because how do you link the two? They're just mismatched assets, and we've had enough with mismatched assets and with leverage from 2008. We don't need any more coming into the system.
Are you seeing increasing signs of this risk building into the market?
I think people are using them, yes, and I think, and I'm worried. I mean, actually, I'm worried in Europe, where in one European country, the regulators are asking private investors not to buy individual shares and just to buy ETFs, which I think is absurd.
Specifically, there are two views on emerging markets. One, that given the fall that we've seen over the last 12 months, 25% fall coming in India, and EM equities have had a disaster year, so to speak, there will be a strong bounce back. That's one. Second, of course, is the opinion that given the uncertainty and the fact that we do not see clarity on how Europe is likely to fix its problem, there will be a prolonged bear market with intermediate rallies in EMs which one can take advantage of. Which camp do you belong to?
I think there'll be a rally, but it won't be as pronounced as people anticipate. With a 25% drop, you expect there to be a rally. Unless I've completely misjudged what's going to happen in the developed markets, particularly in the allocation of capital, you will see some assets being allocated back to emerging markets. And that is enough to sustain a reasonable rally. Not a 25% rally, but a reasonable rally. I think
what would be a reasonable rally for you?
10%.
Okay.
I think in general, people have to sort of get their minds around that the days of making 20 and 30% are sort of behind us. And the traditional amount of money you can make in a stock market anyway is somewhere between 6 and 10% real. I mean, and you can then work it back from that and work out what you'd get as a rally within a particular market. I think the second element is that you will not see eventually, at the beginning, you'll see the emerging markets rallying together with the correlation being close to 1, but at some stage it must begin to separate, because I think people will take country-specific risk into account. I mentioned.
Do you think that's already happening right now?
It's beginning to happen. I mean, for example, people are originally, most foreign investors tended to view China as the anchor to the emerging market story, because they took for granted the growth within China, and then that fed within the region, and that fed within the world. There is now questioning of the amount of growth. It's still there, but it's not as much as before. If you begin to see a credit crisis in China, people might look elsewhere for the anchor. I think if you look at, for example, Brazil, we've mentioned about the BRIC markets, that is much more linked, because of its commodity nature of the market, to the general situation of the world economy, and you'll see some growth there. But it's not going to be the astounding growth that we've seen in the past. So I'm less convinced of a massive rally. The local investors are not yet a strong enough force to be able to move these markets separately from the rest of the world. And it is dependent economically on what happens in the States and what happens in Europe. I mean, ultimately, these economies are still benefiting primarily because they're linking into the growth of developed economies. We're not yet at the stage where they're mature enough for them to be financed entirely by the local economies essentially buying up their market, their exporting markets. But the long-term stories are there. In our pre-chat, when you were talking to me, you asked me about frontier markets. I think part of the element of growing up on the part of asset managers is not just looking at emerging markets individually, as they should. So it's not the BRICS, it's not emerging, it is India, it is China, it is Brazil.
It's going to be an important year in India, given the state elections that are slated, as well as the budget expectations which are riding. And I mean, people are really looking for some concrete measures, some concrete announcements as far as reforms is concerned. What is your overall view on India?
I think that, as I say, generally I'm more comfortable with India because it does have a democratic structure that gives stability. They will have to, like all democracies, balance what they can get through and what they can't, but some measure of reform is expected. Therefore, I'm quite happy. Incidentally, it's fascinating that there are several elections happening around the world in this very crucial year. You have the state elections in India, you have the People's Communist Party elections happening in China, which are equally important. You have the presidential elections coming up in the United States, and of course you have elections in Europe. I mean, this is a year for politics, not a year for economics.
And that would mean managing return expectations, because you can't, catch
the
cycle on the right.
Absolutely right. You have to be careful because you're not sure what politicians will say or do.
Okay, what about the kind of money that you see coming into BRICS? Because last year we saw fund outflows of about $15 billion from BRIC funds. Will that reverse?
Not all of it. I don't see that. Simply because some of that was retail, and the retail investor in the developed world is hurt, and they need the money to spend. Some of that was allocation coming out because of the de-risking movement, and even though I argue that some of it will come back, you can't have all of it come back. So I think some of it will come back, but not all. Who knows? But that is why I'm saying to you, you will have a recovery, but it won't be the 25% equivalent of the drop that you've seen.
But would that mean enough for India to kind of get upgraded from neutral to perhaps an overweight, or is that too early?
I think that's too early. I think India will get upgraded to overweight when people start having question marks about China.
And when will that happen?
Sometime towards the end of the year, and I'm putting my neck out.
Okay, great, Sagar. We'll leave it at that. Thanks very much for joining us. Really appreciate your time.